This conference will now be recorded.
Good morning, ladies and gentlemen. This is Clueless A Trading Frank. It's approximately 10:06 a.m. on September 20th, 2020. Welcome. This is a ACS, that is Advanced Coaching Session training for paid members. The sessions are extremely constructive and helpful to address a lot of different resources that we provide here at Clueless A Trading, specifically technical charts and how to read them, how to make money off them, and all that good stuff. Full disclosure, this is purely for financial education, not for any solicitation or advice, and we shall begin. Keep in mind that these sessions are all recorded. They are stored on GoToMeeting, Citrix.com, and Citrix Online, and also uploaded to the YouTube channel on the Clueless A Trading platform on Google. And right after the session ends, the link for this training session goes up on the real-time Twitter feed. And as you know, that is the main venue for all my alerts, my real-time alerts, my tactical charts, my quick comments, and such. So keep that in mind. If you want to review something quickly, then just click that link that goes up on the real-time Twitter feed. I always pin it, so it's always there, and you can listen to it. On that note, let us begin. So we have Luis here, who is very new, even though he does understand the dynamics of options trading and such. He's still on the on sort of the beginner stage when it comes to it. And we have Rob here, who, from my conversations with him, pretty much specializes on trading exchange traded funds, ETFs, options. Sometime, I believe, right? Sometimes you do options.
Back in the day, yes. Yes.
Back in the day, okay, and you might be, open to, taking some of my options trades where obviously, they are the risk reward ratio is pretty astounding given the volatility in the market. You can make 50, 60, 70% within a day, or if you hold it, you can run up into the 100, 200% type returns, and all that is directly placed on the real-time Twitter feed, as you both know. Okay. So Rob is more into trading the market as a whole in the form of using the exchange traded funds, the ETFs, to trade the overall indices, correct?
Yes.
The S&P 500, the Dow Jones Industrial Average, the NASDAQ QQQ, the SPYs, all that good stuff. And of course, we have the Russell 2000, which I haven't traded lately, but at times when it's opportunistic, I certainly do, which is the ETF. The standard exchange traded fund for that is IWM. We have Matt Merkins, who looks like he's joined us. Matt is a little bit more technically savvy. Hey, Big Mark, are you there?
I am. Was I able to join this morning, or?
You can sit in. I mean, are you? Did you pay for the ACS session at some point?
No, I thought
Okay,
I still had two free ones, or one free
exactly.
one, or
Yeah,
whatever.
we're not stingy about this stuff. Sit on in, man. It'll be good to
Okay.
get your input. Okay,
Okay.
so Luis, I'm going to ask you first. I'm going to keep this in like an open forum thing. Then what I'm going to do is I'm going to go into detail into the way I construct my charts a little bit. Try to keep it as simple as possible, but effective. So we'll do it like that. We'll have an open-ended back and forth. So Luis, first thing that comes to mind, in order for you to take full advantage of what we do, what would you like me to address right away?
I don't know how to understand the charts, but I did see your videos on previously on a chart pattern analyst.
Yes,
So
yes,
I
yep.
know the concept of it.
Okay.
I've been trying to see it when you put the trades up for like the options
Mm-hmm.
since I started on Thursday. I try
Mm-hmm.
to go back and see the time that you put it up and see the chart, and I try to see what you see with the options that you put out there.
Okay, sounds good. So let me get into the real time into the real-time matter of how we do this. So I used 3 different chart platforms. I use investing.com, which each one of you should definitely subscribe to. It's free. Just put your email in. This is a fantastic free service, real-time quotes. And as you know, I produce and construct a whole bunch of these market moving charts, specifically when it comes to overall markets, directly on investing.com. So please subscribe to that, because you need to have a platform that is similar to mine so you can understand the charts better. All right, it's just common sense. So so I use that. I use Thinkorswim for both my trading and charting. That's Thinkorswim TD Ameritrade, TOS as we call it, TOS. So that's the second one, and they look like this. Okay, they look like this. This is Apple, for example. And then I use a third platform, which is a more advanced platform, and any one of you should certainly do the trial with them. It's got nothing to do with me. I've been using them back from my Wall Street days, many years. It's called Quodd, Quodd. I will certainly send you guys the link via text, and you guys should call them up and say, hey, listen, Clueless 8 Trading, Frank referred us. Many of my members use it, and they find it to be extremely effective. It is a direct. I'm trying to get this in for you. It is very easy to read on the eyes, and you can make a lot of money off it. So I used that particular platform too. Time to time, I also used what was the other one? I forget. Because I haven't used it lately. There's a fourth platform that I also use. The name's going to come to me in a second. But those are the 3 major ones. Investing.com, then this. There's your Thinkorswim, this one, TD Ameritrade, Thinkorswim, and then this one. I call this the Algo HFT platform because, as I mentioned in many of my training webinars and stuff, they seem to pick up data from not just the public markets, i.e. price and volume. They also seem to pick up data from some of the private exchanges. Don't ask me, they won't tell you that, but I have noticed that the movement on the movement and the indicators on these things tend to be a little bit quicker, which means you're a little bit ahead of the game than the other exchanges. So Quodd is excellent. They give you a 2-week free trial, and after that, I think it's like $140 a month or whatever. But definitively do that once you become a little bit more savvy and in technical trading. Once you become a little bit more experienced, let's just put it this way. So these are the 3 things that I use. So let's take a look at, let's start off with one of the platforms, one at a time. So let's start off with this, for example. All right. And let me try to bring in a simpler chart, because this is the one that I show the most. ES15 flash fibs. Oh, there you go. So here's a very simple chart and a very effective one. Very effective one. So we had a flash crash. A flash crash simply means a very fast-moving technical correction on the markets. The markets try to bounce, then they fall, then they start bouncing again. And we had that obviously twice last week since the 16th. What day was the 16th? 16th was a Wednesday. So this is from Wednesday. Now, charting, just so you both, all of you understand, technical charting is more art than science. There's a good element of, science involved, but the point is that it is also a way of, it is also a form of art, in the sense that you take these important points, you draw the lines back and forth, then you put on top of that, you dress it up by putting one of the, this one is called the Fibonacci retracement. And before I go any further, as I mentioned before, I want you all to, if any of the terms don't make sense, of course, ask me. But for detailed explanations or any time that I'm putting out there, just go to investopedia.com. Investopedia.com is the ultimate resource for anything to do with finance, any terms, anything. They have expanded a lot. Back in the days, they were just a simple site, and now it is literally the Bible for financial traders. Okay, what is the definition of quadruple witching, which happened on Friday? That's why we had such volatility. Okay, so it's all there, and you just go up here You can type in whatever you want, and it gives you, let's say Fibonacci retracements. You click it right there. All right. It gives you a whole slew of resources. What are Fibonacci retracement, Fibonacci ratios, all kinds of stuff. So the best way to educate yourself. Understood?
Yes.
Yeah. Okay. And this is incredible. So bookmark it. I think they have an app which you can download on the iPhone. It's just fantastic. Okay. So basically, to show you a very simple thing here, so as I was going forward, let me just put my thoughts together. So there's a lot of stuff on technical analysis. There are people who construct technical charts that I don't even understand because they're so complicated. So what I try to do is I use a certain number of indicators, and as you know, Luis, you reviewed the chart pattern analysis, which all of you should. It's one of my first training videos from years ago, and I explain a lot of things very simply because there are many patterns in the market, and those patterns in the market replicate themselves a lot, but nothing is perfect. It might happen over a day, it might happen in half an hour, or it might some of the longer term patterns might take days to come to fruition. In between, lots of chop. So keep that in mind. So what I try to do, I select a few number of indicators, which I'm not showing here right now because this is the external picture of the market. These are price movements, candlesticks, price movements, and definitely self-teach yourself about candlesticks and what these candles mean, because that's something very, very critical. In the old days, people just use a line, like this, um, and people still do. High, low, buy, close. To me, this is not as visually friendly because one of the most critical aspects of technical trading is the visual part. But just by looking at something, you are absorbing a huge amount of information that allows you to act better as a trader. It's really as simple as that. So as long as it gets easier and easier on your eye, then the information is transmitted to your brain faster, which allows you to act faster. And just keep that in mind. So that's what I try to do. So I use a couple of sets of indicators, some really simple ones, and I teach people how to use them for their maximum benefit. I personally track about 22 different indicators, just so you know, because I got 14 screens in front of me, right? This is a professional living, so I take it very, very seriously, obviously. But I don't show all 22 of them because it'll just confuse people big time. But I use the ones which are the most easiest and most effective to follow. And so when I put them out there, you will also be able to do that. So let's take a look at this here. Very simple. So here's a big crash, and this is a big crash. Okay, hundreds of points from Wednesday morning, Wednesday afternoon, right there, 16th. Yeah, it says 2:30 in the morning, right there. I mean 2:30 in the afternoon. And this was Friday when the market's around 1:30 bottom. I think it's a good short-term bottom, in my opinion, and based on this candle here, which is a very long tail, long wick or tail, with this, with the price moving up here, this is known as a hammer reversal. Hammer reversal are very critical, basically because what this is implying to us that the machines which really run the market, as I keep on talking about, algorithmic high-frequency trading computers which run the market, at exactly 1:30 in the afternoon, they started to buy. And that buying comes in the form of new money coming in, millions of dollars within seconds. And also, if the machines were shorting the market, then they start to cover. That, Luis, you also look up. Short covering simply means there are two ways to make money in the market. One, you buy because you think something's going higher. Another is you can short the market betting that it's going to go lower. That is done, as you know, in the form of calls and puts. And you can do that directly with individual stocks too. And there are lots of exchange traded funds that Rob obviously knows about, which also can make you money on the downside, and then you turn around and buy it on the upside. So whichever the case, inverse ETFs. So basically, bottom line is, or bearish ETFs. So bottom line is, this is a identifiable hammer reversal. And once you get a hammer reversal, you generally tend to get a surge up. Now, this is a 15-minute chart. This is a 15-minute chart. So it's looking, each of these candles are what's happening every 15 minutes. And as you know, and this is very critical in technical analysis, that as you zoom out, if I go into, let's say, the 1-hour chart and the daily chart, which we will, there will be less of these gyrations back and forth. As you zoom in, just like anything in life, I always look at it as an analogy of a microscope. If with a microscope, when you're looking down at a whatever you're studying, let's say a frog or whatever, back in high school biology or in college, or you're looking at a drop of blood, you start to see a lot of movement in there, right? So it's because you're zooming in. So there's more in the world of markets. It's called noise. Noise basically means volatility, buying and selling on a very rapid basis, and that's why each of these candles are so let's put it this way, busy. It's a busy picture. If I go into 5 minutes, it's going to get busier. Look at that, because each of these candles now is 5 minutes. 15 minute, it's getting less busier. 1 hour, far less busier. Now each of these candles are 1 hour. This is when the market started at around 9 o'clock, well, 9:30. This is 10 o'clock, so market started somewhere around here on Friday. And as you can see, every hour what the markets did. Now, as a trader, if you wait around for an hour to get into something, that's fine, but then you're not going to make the money on the 15-minute turn, because you could have gotten in here, and you could have actually sold here if you'd like, at within a matter of 2 hours, or you hold on. But whichever the case, your entry point is more effective. You get a better price point if you're looking at the 15-minute chart. Did you guys understand what I said, especially Luis?
Yes.
So just like anything else, so zooming in will cause more noise. This also means that if you are in a position and it's starting to slip down, you tend to get traders tend to get a little bit nervous. And that's why my structured charts sort of try to keep people very calm. And I talk about that quite a bit, even during the day, especially during volatile days. And at that point, if things are getting really choppy, then you switch to the 1-hour charts that I produce and look to see whether or not there's real damage being done, or is it just back and forth choppiness on the 15-minute. As you zoom out, like I said, the noise becomes less and less. And then you see a little bit of the clearer, bigger picture. The bigger picture is all fine and good, but given the volatility in the market and given the machine-driven nature of the market, it's not always that effective in making money. Okay, just so you know. But I always look at the big picture to keep myself grounded as to whether there's been real damage done or whether it's something which is more temporary. So I just want to be clear on that. So let's focus on this chart here. It's a very simple one on a Fibonacci retracement basis. So when you have a massive up or down move on the markets or an individual stock, I will go ahead and produce a Fibonacci extension, Fibonacci retracement chart to get a technical idea of where we might bounce towards. I would say good 80% of the time I've been dead right on any type of dead cat bounce, which they say, but we call it a reflex bounce or a reflex rally, or so basically, where can it go to? And this is where the Fibonacci retracements come into play. Basic rule of the thumb is each of these are Fibonacci levels. I don't construct it. These are standard ones. The one at the bottom starts off from 0. Then you have the second level. which is the 23.6% or 0.236. You just move the decimals a little bit to the right. Okay. Next one is these are standard Fibonacci retracements. In other words, the market where it can bounce to on a technical level. In this particular case, going into Monday, tomorrow. This one is 38.2.382. This one is one of the most important ones. Anytime you have a massive fall or a runaway type of upside market, which we went through a couple of weeks ago, before the market started to, breathe out and pull back a little bit. Anytime a sharp move up or down happens, they tend to have a very high probability it's going to come and hit and retrace half the gains or half the losses in this case. And that's known as the Fib 50. Well, we call it the Fib 50, Fibonacci 50 level. Very, very important number. And like I've shown it dozens of times. Matt knows that just within the past couple of months, how many times that when the markets have pulled back, that we have come back and retested the Fibonacci 50 level. Okay, so now the third thing is when we're looking at this, so this is with a blue dotted line. That's the one I put across. The one above that is the 0.618, that's 61.8 Fibonacci retracement. That means the market is taking back on 61.8, let's call it 62% of the drop. In which case, the whole pattern in that case has changed. I'll go through that in a second. And of course, the upside to going back above 3,400 on the S&P 500, and this is the futures, obviously. It's pretty much the same, give or take a few points, just like the SPX. Then there is a possibility that we go back to the highs into the 3,420 level. We don't know that yet because that's a good 800 points from here on the Dow Jones. All right, we don't know that yet. Maybe it happens. We shall see. So the first thing that happened was it bounced off hard, hammer reversal. This is the way you read this chart. And now it's moving forward. So we bought the lows, as you know, and things came back pretty strong. And of course we started things that we were down on selective basis. I started buying those, adding more at a cheaper cost to lower my cost basis or lower the price of average cost of those options in there. And of course initiated a new position in Zoom, which I should have done earlier on during the day. I really wasn't didn't notice that, and it was just incredible. I mean, Zoom was up a gazillion points. Right after I told people to buy it, it went up like 50%, like literally in 15 minutes, and it still kept on going higher. So so that's just the way it goes, and that has partly to do with Oracle, just so you know, and this TikTok thing that's going on. So anyway, Zoom is kind of a beneficiary of that picture. So all right, so at this point, this is the downtrend line, standard procedure. And it's a very defined one, and it just happens to be exactly intersect the Fibonacci 50 level. So if the markets open up strong tomorrow, who knows? We'll find out after 6 p.m. tonight when the Globex futures start trading, an indication of where the markets might open up. Even though what happens after 6 p.m. doesn't always pan out. What happens at 9, when the U.S. markets open at 9:30, we know that. But let's say we have a very strong open, what we call a gap up, which would be fantastic. We'll be able to sell some of the things that we bought at the lows at a very nice profit. Then I am looking at this barrier here as a major resistance point. So this is giving me an indication, a GPS roadmap, like, hey, this is where I expect the markets to get to before it starts to sell. Now, that sell, I'm not saying it has to come all the way down here, but what I'm basically saying is this is going to act as a major resistance. And if it breaks above that, we know what the next level is. Now, this is obviously, markets are never perfect. So I'm not saying that, it's going to get exactly there, but this is the general idea. So we know what's coming up in front of us if we continue with the sharp bounce that started, or reflex rally that started at 1:30 p.m. on Friday. Questions, anyone? Because this is real simple.
No.
Okay, good. Now let's dress up this chart a little bit more. So here you go, indicators. So one of the first ones that I not first ones, but this is how I dress up this chart. I put the Bollinger Band. The Bollinger Band is just a wave pattern. And again, go to Investopedia if you want to study the, get the real definition of the Bollinger Band. It's basically a wave pattern of prices. It's a ribbon. So I put the Bollinger Band. Upper Bollinger here is 33.28. So it's giving me an idea that, okay, can we turn this wave? What we really need to do for people who are generally long the market is, or have calls, we need the Bollinger Bands to start to turn. Once that starts doing that, then you are going to attack the Fib 50. The Bollinger Bands start to, expand more, let's say, and then you can look at 33.66. So you're talking quite a few hundred points, up. So that's first thing we dress up is the Bollinger Band. Next. And these, any of you guys can do it. This is the good stuff and it works. There's lots of indicators, all right? Lots of them. Then you can go to stochastic. This is the most powerful and easy indicators that you need to track. And I show them on almost all my charts, as you know that, because it works. I don't want to make this overcomplicated. Go here, make it a little bit more visible. You can put some price lines if you want. Okay, there you go. So now we're starting to dress this baby up to give a better idea. So generally speaking, real simple stuff. When things get, and this is a 15-minute chart, so it's a very short-term chart. We can expand this to the hour and you'll see the difference. So when the Bollinger gets down here, and this is for active traders, if they're trading intraday, or even if they're looking to trade short-term or looking for an entry point, when it gets down here, it simply means it's oversold. What does oversold mean? Prices are cheaper. That's when you get this big thump in the market that came at 11:45, when there were big chunks of stocks were sold, and then came this big red candle, this fat one that dropped the market. Boom, another 100 points or more. Came at 115, and then at 130, the whole market turned around. It's just the way it goes. All right. So the panic sellers and the ones which had, if you have stops in there, they take you out big time. You guys, I mean, of course, many of you know, but Luis, you understand, stops, like, you buy something and you say, you put it in the system. Let's say you buy a stock option at 4 and you put it in the system 2. That means that you don't want to lose more than 50% of your money. Automatically, the system will take you out the minute it kisses 2 or goes below. Right?
It's basically, it's like a stop loss.
Correct. It's a stop loss. It is not it is a stop loss. It's self-stop. Okay, exactly. Now, generally speaking, these are the periods where the machines are so fast and they're doing the dump phase. Like, for example, here at 115, and right there, they have taken out the stops. Cha-ching, gone. So you're gone. Like, you took your 50% loss. And it's basically also directly tied in with emotional traders who are not trading charts and just trading prices. They are at that point, whether stop loss or not, they're selling. They're like, that's it. I can't take this anymore. The voice in the brain says, that's it. I'll come back later. Well, guess what? That come back later is exactly when the stochastics, which is a first derivative of the relative strength index, just hits rock bottom, and boom, they turn around, and the people whose stops got taken away and the people who sold here sit there and basically cry, because the market just zooms past. And if you notice, the market was down, I think, almost 400 points, 300, high 300s, and literally within half an hour or less, it was only down 170 points. Okay, that's just the way the markets go. So this is what the sell stops and the stops are triggered, and there is that massive flurry of sells associated with a short-term bottom in the market. It's just the way it goes. So let's zoom this out and put this. So that's the stochastic is a very powerful tool. You want to keep an eye on whether it's getting overbought. That means the market is having that short-term pull up, and then the pullback starts as it starts to come down. Now, next, we use you can use the MACD. Now, the MACD is also a very powerful tool. Please look for the exact definition. It's moving average coincident divergence. Fancy long word, been used by technical analysts for a long time. I think it's a very effective tool. And I am going to show you. Put this in the green, that's better. Put this here, very simple. So let's study the MACD for a minute here. MACD also is going to be rock bottom right at the point of maximum pain max pain and right there at that point, the point of capitulation on a short-term basis. Basically, I give up kind of thing. That's where the sell stops go and things hit rock bottom. So right there, look how the MACD. Now this is a very positive picture, the way the MACD turned, a crossover of the different values, the 1226.9 in this case, and just look at it visually. Forget about the numbers, all right? I don't even tamper around with the numbers. Serious technical analysts, they'll change these numbers around to fit their parameters. I'm like, I don't have time for that. All I know, it works like this. So the key is that, make this a little bit bigger. There you go. This should be red. These are in the red because it's below 0. This is in the green, but I don't know how to change the color on that. I gotta ask these guys. They should be able to. You can do it if I find the lines easier. You can do it as an area. Okay. But I don't want to. 1 second. I just put the lines, histograms. Oh, there it is. No, I don't want to do that. I'm just going to stick to the line. There. Okay. So just keep that in mind that when it's below the 0, that's actually red, and then it's going into the green. Make a long story short, this is another powerful indicator. Very easy to see, very easy to trade. You can use it in all different time frames: 15-minute, 1 hour, the daily. And as you're zooming out from the zoomed in, sort of the big noise type of thing, active trading type of thing, this is a 15-minute one, then you start to see a more clearer picture. So these two I use, and the Bollinger's I use often, and of course there are other indicators. And as we move to in the next training session and stuff, I'll get into those hardcore chart construction and stick to this for today. So far, any questions?
No.
Okay, let's move on. Let's look at the same picture on a 1 hour basis, and we can start to see here that in this particular case, the 1 hour, zoom out, there you go. It's much more cleaner to read, much more cleaner to read. And so is the internal. The internal looks like this, and you can see here, oops, sorry, what happened here? You can see here that the stochastics are just starting to turn up, which is a very good sign. That means that we have much more room to move up till we get really overbought. So if we have a strong open tomorrow, then it's going to look like this. It's going to be up here. And once it gets up there, most of the time, and that means the market will hit this level. Okay, and that would be up almost 40 candles on the S&P 500. I'm going to call it S, will most probably be up 40, and it's very possible. 40, that means the Dow Jones, I'm going to say D. Okay, the Dow Jones most probably will be up 300, and it's going to be bright green right at the open. Now that bright green can suddenly turn around, as we have seen repeatedly, and suddenly turn around, hitting these levels, and then start to come down. So you have to be quick in taking the profits at the open. At that point, we'll be overbought. And if it does do that, and there's a pullback, then there's a good chance that the 1 hour will reset. We call it a reset from overbought to oversold. There'll be a reset within the first hour of trading by 10:30 or so. You notice how when markets open up a lot, they kind of start running a little bit, and then by 10:15, 10:30, they get softer. You guys notice that?
Yes.
Because a lot of it has to do with profit taking. You know, the machines go into effect. Let's say they didn't buy on Friday, so they go into effect around 9:30, 9:45. Boom, they push the market higher, and by 10:30, they take their first batch of profits, and then all of a sudden things start to slow. You know, it gets soft. You know, Apple could be up $4. All of a sudden, it's only up 50 cents. Like, what the hell happened? Nothing happened. There's no news, nothing. It's just standard movements of profit taking and such. So those are the simplest ones that we use. Those are the simplest ones that we use, and you can see how clear it is here in this picture. If we look at the daily, for example, and let's take a look at it. Let's pull it up here. If we put the same chart on the daily, it's a totally different picture. The daily is not confirming yet, and the daily is for like more of a slightly longer term picture, like what's going to happen over the next couple of weeks, you know, or what's going to happen over the next couple of days. I would say more likely, yeah, like towards the end of the month, which we are approaching pretty fast. This has not confirmed a turn yet. You notice that? It has not confirmed a turn yet. On the Stows, 1 second. Here, it's not confirmed the turn yet. There's a couple of things playing around here. You notice this is a higher low. Watch. This is a higher low. There you go. Than what was printed on the 8th of, I'm sorry, or September 8th. I'm sorry. No, what am I saying? September 8th. We had hit this low here, and this is on the internals, and we are hitting a higher low. Now, compare that with the price action on the front side. Try to explain to you guys. On the price action on the front side, this was August 8th. I'm sorry, August 8th. August 8th was down here. Sorry. Here, August 8th. Focus on this for a second. Come on. Sorry about that. Let me try to get the pen. Okay, so August 8th was here. Was the price on August 8th pretty much the same? What am I doing? I should be looking at the daily. My apologies, guys. What am I looking at August 8th for? My apologies. Hold on. Okay. We hit rock bottom on the underlying indicator on the stochastics on September 8th. 9/8, September 8th, and that was right here. The price was here. The price on Friday at 1:30, when the markets hit that thump, was lower than the where the markets were on August 8th. You guys see that on the lows of the day? Everyone needs to confirm this. Say yes or no.
Yeah.
Okay. Now, what do we see on the internals? A higher low. Oh, and then on August 11th, I'm sorry, I can stuck with August. September 11th, we also hit a similar low, which was higher or lower than the lows on Friday, which was the same as September 8th. So let's just keep it this way. So we hit a lower level on the prices, yet the internal made a higher low. Do you understand what I'm saying?
Yes.
Here we hit the same prices as September 8th, but we hit a higher low. Next 3 days, next 2 days, the market shot up. Next 3 days, the market shot up quite a bit. We have now come back to those levels and breached that support and went lower, but we did not hit a total low based on that. That is known as a positive divergence. In other words, the internals are suggesting, the internal indicators suggesting that the level of sell pressure and the so-called smart money, I don't know who that is anymore, is not selling as hard as they were back here before it turned. So this is considered to be somewhat of a positive indicator, what known as a positive divergence, telling us that we do probably have a couple of days of a sharp bounce in front of us. So this is like predictive stuff, but it works. So let's see what happens. Just wanted to, show it to you guys. Okay, so this is in simple term, without like pushing it too far, is what I show on multiple charts. So let's say, for example, let me bring a actual constructed chart that's in there. Let's look at the daily. This is the daily chart of the markets. No, let's look at the 1 hour. It's 1 hour. But I had that here. That's a 15-minute. I think this is this is the 1 hour. I got to correct the. There. Now this to me is a pretty exciting chart from a technical standpoint, because it's telling us that even though we fell that hard starting I was going to say August again. Somebody slapped me. September 8th. Look, first and foremost, look at these two. That we are still within a very wide range, and that range was 34.46 and this. Can everyone see that?
Yes.
Oh, it's like boxed in. So let me get a box and like put it over it like a rectangle. Like I said, technical trading is a very visual thing, and if you can see these things clearly, let me change the color scheme on this. Let's make it very light green. There you go. Okay. See, now we have a picture here. It's a picture frame, and the picture frame is telling us, and this is what it's telling me at least for now, that there is a very strong floor on the market at this level, which is around 32.95. And if the market does what it should do, then we have you have all these levels that we can get to, and that's money in the pocket. That's money in the pocket. And whether or not we get up all the way up here, I don't know. We have certain positive things have to happen on the outside catalyst, like getting the stimulus bill passed by the Congress and the Senate. The TikTok deal finally looks like it's almost done. If you read the weekend news, that's good for technology. We need to get certain positive catalysts that have to come into play, and then we can get up there, because this is a long way, not a long way off. That's a lot of points. Like from 3,300 to 146, just to give you an idea. It's 1,200 points on the Dow. That's a lot of money. That can make you super rich real fast, okay? If you stuck with the game, seriously, on multiple fronts. Even a move from up here to there is 150%. Forget about going up here. I mean, those calls would be up like 500%. All right? And some of my traders who are total believers of these charts, and I'm a believer too, but some of them are more believers than I am, trust me, because I like to be a little skeptical of my work. That's the way I've always, led my life, like self, constructive criticism, like, hey, I can do better, I can do better, I can But some of them just blindly buy it and just sit there, and they're just like whooping money like a couple of days. And I tend to take staggered profits. If I'm up 60%, 100% on something, I'll take those profits down, and that's another day session. And I have training sessions explaining all that. I'll move on, especially in options, I'll move the strike prices higher. If you buy something at, let's say, $20, something a stock, let's say, is at $100 and it jumps up $20, why should I be sitting at the original options with a strike price of 100 when I can buy the 120 calls at that point at a cheaper price? So I like to do it that way. And I have some great training videos explaining that simple strategy of rolling over into higher prices as the directional bias of that stock or option is moving up. Do you understand what I just said?
Yes.
Okay, good. It's simple stuff, actually. The complications come in our business because of this intense volatility that's generated for different reasons, and then it's amplified to a scary degree, with these type of moves. Yet there is a pattern in place by the machines. That's the difficult part. Otherwise, my chart should be working 110% of the time. They generally tend to work very well, even in difficult markets, but it becomes tricky sometimes during the day. And I'm the first one to say that, obviously. So saying all this is a pretty clean look. No Fibonacci's, nothing. Each of these lines are showing the levels where the supply came in or the sell pressure came in. These are the lines. The red lines are support. They're also telling you where the buy pressure comes in, or where the buyers start to get in the picture. Look at that. This is a 1 hour chart. So Luis, when you look at something like that, because you're very new to the technical game, what's in here that confuses you, so I can explain a little bit better?
Well, before seeing the video of the chart pattern analysis and seeing the way you explain it, it makes more sense to me now. But before,
Okay.
I was just looking at it and I didn't know where all the lines were. But just from seeing it, and I was seeing like the bounce and everything now here on the chart.
Okay, so let me that's that's excellent that you're catching up that quickly. This chart, by the way, was drawn at the beginning of September, and I kept on updating it as we moved along. And this chart has made me money, or at least it made me stay calm and not like sell things stupidly at the wrong time. Specifically, the market indices like the SPY, S&P 500. So you see this thing here. There's a lot of things going on here. This because it was drawn at the beginning of the month, which wasn't too long ago. You have a cup, the pink line,
Yeah.
and then you have this line here, which I kept on extending forward as the days went by, but this is called a cup and handle. And we were holding this cup and handle very well till about the 10th, and the market was bouncing very nicely. See, that's a cup and handle. This is a cup and handle. All right, so right there. So it's bouncing. Then it started to give in and it lost the handle. And this lost the handle came about around the 10th. It came down, attempted to move up, and that's when I drew this green line here, this one.
Okay.
Because now I have an uptrend line in place. See that?
Yeah.
Exactly. Now what the markets did over the following days, it actually stayed above the uptrend line, this line here, this green line that you guys are looking at. And it was doing fine. It was doing fine. It almost took out that original upper end of the cup, but it failed. It actually did take it out, almost. And then this big sell program came in at around the 16th. Okay. So at that point, it broke the uptrend line with a vicious move down, attempted to bounce. And I'm going to show you a couple of things happening here so you guys understand it. Because we're talking about technical, so that's what we're sticking on. So let me do this. Make it bigger. Let me take this. I'll leave it in there. No, let me take this box out because I just wanted to, because it kind of messes up the thing. Okay, that's better. Now, you had that cup, you had that handle, all kinds of good stuff. Now, I drew this line here. This actually should be in green, not in pink. I kind of used the pink magenta line just to show the cup and handles. So there. So all of a sudden we have this is known as a channel. Okay, known as a channel. And so it was fine through the channel, and then it broke the channel. And then all this came into play. Now, this line here, and if you've watched that chart pattern analysis video, this is known as a neckline. This one. This is a inverse head and shoulder. Left shoulder, right shoulder, head. Look at this move here. That was a very powerful hammer reversal. Once you see something like that, you want to go long right there. And that happened at around 6 in the evening after the market closed after hours on the 8th of September. This very long tail with a little hammer. These are very powerful indicators. These are also quite powerful indicators. This candle, the body of this candle is far bigger than this previous red candle. That's a bullish engulfing bar, bullish engulfing candle. That's also very positive. It soaked up the selling and then just went well above that. Do you understand what I'm saying?
Yes.
Guys, okay? These are just reading the tea. What we're doing here is we're just reading the tea leaves. They're not perfect, but they work. They work overall, but certainly not perfect. And then, if you notice, I'm gonna fit this in the screen. If you notice, wow, this doesn't even fit in the screen. Okay, here. Big fat, not big fat, but big skinny, but very powerful. It's also called a dragonfly, whatever. It looks like a dragonfly. It's a hammer reversal. You guys see that, right? Clearly?
Mm-hmm.
See this? That's a hammer reversal. Same here. Is a very powerful forward signals, at least from a price standpoint. This is a bullish engulfing. It's not really a hammer, it's just a bullish engulfing where the body of this green candle just absorbs the selling from the previous hour. Big time nice. Hammer reversal. More importantly, look at how many hammer reversals in the market tried to bounce since the 17th this week. 1, 2, 3, 4. And it did go higher, but then gave in on Friday. Now here's the best part. Look at this hammer reversal, the length of this tail. That's almost as long as this one. So these are the two major inflection points that are right now. Hopefully the market plays out and we have one of these type of moves. This is the same type of candle as this. In fact, this is more powerful because right after that, same things happening, guys. Look, same things happening because the machines are coded a certain way. They replicate moves. People don't like to believe that, but that's just the way they go. So I'm looking at September 8th and Friday, 1:30 p.m. as a short-term major bottom. And I know people like Rob will use that type of information, look at my chart, and do a decent amount of business with his exchange-traded funds, correct?
Yes, sir.
There you go, because you're more of a swing trader than scalping during the day, correct?
Yes, but I started doing more intraday with your charts, so I feel
Good.
more confident now. Yep.
Yep, and the reason one should do that, because I do a mix of both, is because because the market, when they get choppy like this, it's very difficult to predict what will happen tomorrow. When the markets have a definitive type of reversal like this, at least I can say, hey, I think we have a couple of days of a very powerful move where we can take down some real nice money off the table. But if it starts to do this again, then I'm going to be taking some quick profits intraday or lowering my size of my positions, because that's when it gets nutty. And there's nobody who will be able to do that if it starts doing that. If it starts to follow this type of pattern, and that's why I rely on charts all the time, and it breaks above this, and my Fibonacci chart, it's breaking above that 50 level, all that stuff, then I have a certain amount of reliance. The problem with a lot of traders are they believe that they believe that if when things are starting to move like that, that there's an absolute, not an absolute guarantee, but there's very high guarantee that it's going to go higher. No. And that is where the volatility aspect comes in. I want you guys to understand that part. So if you are up maybe 20% or 30% and the market's like going in this choppy mode, take it, sit back. Or you're up, the market's open up very nicely on Monday. First thing I do is I take down the profits on most stuff. Not necessarily get out of everything, depending on the size. If I have like decent amount, I have a decent amount of calls on the SPYs and Netflix and Apple. Netflix was up for the day for me. That's the last chart we're going to look at. And I hadn't been trading Netflix for at least a week now, or a little less. Last one was like a really nice move. So you take down the profits. So questions before I move on to the next chart.
No, not here.
Luis, Big Merc, Matt.
I'm good right now.
Okay,
Yeah, I'm good as well.
it's Matt Fung, right? Hey,
That's
what's
right.
up, man? Yeah, because you're more advanced in your stuff, so this was actually a real beginner one. I'm glad you stopped by. It's cool. Okay, let me look at and this is an exciting chart. These are the money charts. Okay, where is it? Where is it? I'm gonna find it here on my screen. All right, won't let me find it. Oh boy, hold on one second. Give me a second, guys. I'm trying to find one of my. Here it is. Sneaky little thing. So I'm looking for. What's wrong with the mouse? This is the annoying part. Very strange. It won't let me click here. What a pain in the butt. Hold on one second. While I'm doing this, just ask any random questions and stuff to be good use of time, if you'd like. Okay, this is really annoying. It won't let me. See, it's not allowing me to do that. Let me try to move it out of the screen. Maybe it'll allow me at that point. No. Okay, so I'll have to draw a new one then. All right, so let's bring this in. So this is of the Quad platform, the same platform that you guys see on, I always joke around, you see on Billions, the show, except those ones never move because those guys didn't pay for the live screens. They paid for the dead screens, which I think is hilarious. It's one of the like top rated shows on TV, on cable, and you got all these big hedge fund billion-dollar guys, and you look at the screens and they're flat. They don't move, you know? It's pretty funny. So let's do it. Yeah, it's really hilarious. I actually know one of the partners at Quad. I said, dude, what's going on with this stuff? You know, it's borderline hilarious, especially for us traders. You know, it looks like those old when you went to Radio Shack or Best Buy, they had the cardboard things with the picture behind the TV, right? Back in the days. So it's like it's the same thing here. Everything's static, and he's laughing because the guys were real stingy, and then the producers didn't want to pay for live screens. I'm like, great. All right. So I will, I wanted to show you, oh, I got it, because it was a picture perfect. Okay, I got it. They gave me freedom here. All right, Netflix. So for Netflix, I had the falling wedge. Where is it? Ah, there it is. There it is. Okay, so so I looked at Netflix on Friday. This is constructed on Friday. All right. So look at this. When you look at the quad charts, the dotted line, yellow line, is always the pivot. Please look up the pivot. Simple rules. Above pivot, good. Below pivot, not good. If you're buying below pivot, at the pivot line, PIVOT, and look it up on Investopedia, and it's starting to move up like absolutely beautifully, touches the pivot and looks like it's going to break above that, bang, you just made yourself some real nice money. So this is when you look at this chart, first of all, I looked at Netflix, I saw how oversold it was, and that was at 1:15 p.m. on Friday, right there. I started to see and I constructed this chart with the markers. And every single time the stock on a short-term basis bottomed, the stochastics bottomed. This is S stock. This is known as a slow stochastics, more for swing traders, like a swing stochastics. This is more for day traders, which get overbought, oversold during the day. I give a lot more weighting to this S stock or slow stochastics because this allows me to stay in the game and hold this thing overnight. Are you guys with me so far?
Yes.
Okay, so this is a very constructive chart, and hopefully it works out in a big way. It's already working out for Friday. So every single time the stock bottomed, and there was that little flicker of a mini candle, and it started to turn zigzag its way up, the stochastics bottom. That's why these markers are put in place. Look at that. Here, this was back on the 14th of September. The stock at 1:30 p.m. hit 472. Stochastics hit rock bottom. It started to turn. The stock the following morning at 9:45 a.m. This was 9:14, 9:15, 45 a.m. was at 495. Ladies and gentlemen, you just made coin. Just selling first thing in the morning. All right. If you bought it the day before, and I think we did this trade, at 471, the stock opened up with the market up 25 points. Stochastics got overbought. It still continued to move sideways, indicating to me that the stock had more strength. It certainly did, even though I was out. Yeah, we did this one because I had the 505 calls, which were back in again. Yeah, 505 calls. Yeah, we did this trade. It was huge. The stock kept on moving higher, but I took most of my money out here. I think I had like one call left or whatever. And then it hit. By this time, you notice this is starting to curl down. In other words, is losing pressure, but the prices continue to go higher. And the prices reached on the 16th, which is 2 days after the alert, hit 505. Exactly what I showed. And this I showed on my Thinkorswim platform too, in the form of trading ranges. You guys obviously understand trading range, what a trading range is. So the trading range was picture perfect. It was 505. That's what the 505 calls. In this chart, I'm showing you a different look. But as Wednesday started to go, This is what the stock did. So I'm out of it at this point, as you know. So Wednesday, I'm out of it. The stock gaps down, falls, rises. At this point, I'm not in it. This is Thursday. Again, it reached rock bottom, both on the internal, confirming that the stock had hit a short-term low. So if you had bought it here, $463, bought some calls, let's say the 470 calls, I would buy them a little bit out of the money, or 465 calls, then this was at 12:45 p.m., let's call it 1 p.m., and it hit the next morning, it hit 479. Ladies and gentlemen, that is a 15 to 16 point move. You just made money. Okay, it hit the gap. This is known as a gap fill. Again, look it up on Investopedia, the theory behind gap fills. Okay, and whether it's what are gaps? You know, upside gap, downside gap, all kinds of stuff. It hit the gap exactly. By this time, it also hit the downtrend line. I'm not in the stock, right? So I issue an alert to you guys Friday afternoon, pretty much right around here. I think right around here somewhere. Stocks slipped a little bit more, even though the candles were looking good. Stochastics had bottomed. Time to buy. So if the stock gaps open tomorrow at 478, normally it'll gap open anywhere from $7 to $9. Unless some bad news comes out on Netflix or whatever, who knows, that's the risk we have to deal with. Again, very simply, you want to be a seller right there at this exact level, because at that point, there will be some selling. Now, maybe, who knows, maybe there's, I mean, the analysts have been falling over each other over the last couple of days, like upgrading Netflix like crazy, who knows. But generally, here's your gap open, you want to be a seller. This is standard procedure with all my trading stocks. If it breaks above that, then you have the next level that you have to contend with, and that is around 496. So this is a picture perfect chart. Stochastics, the internals matched with the externals, the price action, and the stock started to move. This is a W pattern. Again, you want to be a seller at this level, and if it overshoots, it overshoots. But let's say you have two calls, then sell one and put a trading stop on the other one, so you get taken out at least with profits. It's really quite simple as that. The big picture, meaning a couple of days, not months, going into, let's say, the market's strong tomorrow, continues like that into Tuesday. The big picture is the larger, the larger W formation. This is known as a dragon bullish. Double bottom, neckline. This is the neckline, the gap fill. You seldom see technical patterns on a stock like this clearly. There's your neckline, breaks above that, the next level is 496, call it 500. So it's a very defined trade. If it falls, let's say bad thing happens tomorrow morning, if it falls, again, I'll be a buyer at the 458 level, which is acting as very, very strong support. Let's call it 458, 460. Are you guys with me so far? I'm kind of walking you guys through a very structured tactical trade.
Yes.
So let's say somebody's not in Netflix but wants to play it. Well, then in that case, don't buy it when it hits here. But if it starts to pull back, of course, I'm going to show it to you. Or let's say bad things happen and the stock falls 11 points at the open. I'm not going to like it because I'm long it. Even though I took profits, I still have a strong position. I'll be a buyer here, and you could be entering at that level. So this is your short-term W pattern hitting the 480 mark, which would be very nice. That's 11 points from where it closed at. Upper gap is 484. Remember, there's your upper gap, there's your lower gap. And then you got the top end here at 496. So a lot of the times, traders who are not trading off these type of very precise tactical charts, they get excited right at this level. And guess what happens? Boom, they sell it down before they take it up again. So this kind of stuff happens all the time. Now, there's another thing happening here, which is these two lines here. This is known as a falling wedge. A falling wedge is a very powerful pattern. And guess what? It broke above the falling wedge. Look, right there. This is like picture perfect technical analysis, you know, and it normally doesn't look this perfect. So it's a falling wedge, and it broke out over that with hopefully a continuation pattern to retest the lower gap fill here, which is around the 480 level, 477. So this is again another type of structured trading roadmap that you guys can use very effectively. Questions before I wrap up? 11:16. Any questions, please? I'm here to, you know, to answer that. Luis is
No,
go ahead.
I'm following pretty well.
Good. So because I think you are getting a hang already in these past 48 hours since you joined on the type of things that we are good at. We're not good at everything, but let's put it this way. There are many different ways to skin the cat or make money in the stock market, right? So everyone has their own thing. I just basically try to keep it reasonably simple so that my traders, you know, with a little bit of training can really, you know, pick up on this stuff. I really don't want to get overcomplicated. My biggest strength is I do understand the US markets quite well. So a lot of my predictive analysis come right, as you guys know, both over the short period of time and the longer period of time, because I am not just using charts as the ultimate thing, but I'm also using my experience and my all those years working on Wall Street, and also my knowledge about how markets react to news. And that's why I am, you know, I tend to be a little bit ahead of the game. There will be times, I'm just warning all of you, as you know, there will be times, maybe, you know, especially in very choppy, volatile markets, where I will be doing things and suggesting or recommending or showing which will make no sense to you. It will make no sense to you. Like, why is he doing that? Yeah, I'll try to be as explanatory as possible, but that has to do with the fact that I generally am always a little bit ahead, especially when the markets drop hard. It's a little bit ahead of others before the market starts to show that movement to where I think it's going. So there will be times like that. So you can, you know, you can always DM me directly on Twitter and say, hey, I mean, I'll try to be as explanatory as possible, you know, within reason. But there will be times that it's just not going to make sense. But that's, you know, and it's going to work out. But it's not going to make sense at the time that I'm actually doing the heavy duty buying or whatever. So this is the clearest roadmap that you guys need to follow, in my opinion. One of these type of charts, they're very clear, and you can see what's going on. Now, if it gets like this, back and forth like this, chop, 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 this was actually turning out to be. Let me show you one thing interesting. This was actually turning out to be a large. Come on, change the color. W. That's what it was turning out to be. Till
Yes.
Friday morning. Okay, so basically, so that's one way to look at it. The other way to look at it, which I did see, but I didn't put out there. The other way to look at it was, this was a, what is this? A bear flag. Got it? So that's the
Yep.
other way to look at it. So in this particular case, the bear flag worked, but it wasn't meant to be. All right. And the bear flag, this is what this is a bull flag, right? One pattern of a bull flag, and this is the bear version of it. So boom, it was classic bear flag movement, quad witching, hit the bottom, and now this bear flag, we call it negating it, or, you know, basically destroying it. This bear flag needs to get destroyed above the downtrend line, in which case it will no longer be a bear flag. And at this point, we have another W motion in play. Look, there. Okay, and so this continuation pattern, I think, will be where we get up towards those levels here, the FIB 50, all that stuff, and boom, they hit the market again. I don't think we're gonna. Who knows? I mean, these markets are so volatile. I'm not going to make a intraday prediction, but can it come down all the way here again? Maybe, but I think this is a pretty strong support. So, ladies and gentlemen, this is what is just a glimpse into the world of technical patterns, technical analysis. Don't get too engrossed with it. Believe me. All right. I love doing this stuff. I mean, I look at a chart, it kind of, I'm not saying naturally, but it kind of talks to me like right away. But just stick to most important thing is to use these tools so you can get the messaging. But the most important thing is how you manage it, how you manage your money, your trading money, which is your risk capital, using these things. And that is something that you guys got to learn. Some of them who want to move on to level 2, they sign up for the ACS sessions, advanced coaching sessions. I get into the nitty gritty of it, how I do it. You find your own style, how you do it, because you can have the best frigging charts in the world, like I say, all right, that I can show predictive charts. Yet you didn't manage your position right and you didn't make money. So that is the most critical aspect of it. And of course, using this GPS roadmaps. So on that note, please, the only thing we ask you all is if you found these type of training sessions helpful, then please provide us with great referrals. We'd like to grow our community, and also put in a good word on, DM me saying, hey, I found this to be really exciting, or you found this to be helpful, this and that, so we can basically put it up to show as just our generic marketing, so people can see that you were helped by these type of things, and they would be more open to sort of learning more. On that note, quick reminder, we have our weekend webinar at 8:30 p.m., probably 9 p.m. when the Chinese markets open, probably going to be 9 p.m. tonight. So if you're around, then certainly attend that, because by that time we'll be talking about live discussions with the global futures, and that's everything. And hopefully these things that I explained to you right now should come into play, and you'll see how good, how magical that is, just the way it works. So yes, our webinar is at 9 p.m. tonight, our weekend webinar, and that's it. So let's get off to the races on Monday. Let's do it right. Let's try to make some money. Have a good one, and thank you for attending.
Thank
Thank
you.
you, Frank.
Anytime.
Great session.